David, thank you very much for coming as a speaker to this conference. Just a specific question on Basel. I mean, Basel has kept many institutions busy for the last, I would say, at least 6 years. Pillar 2 is still keeping a lot of people busy. It's clearly not implemented. Pillar 3 has hardly been touched yet. What is your view on the state of the of that program? Where are we, and where are we moving to?
But I think there's three things really. I mean, the first one is we're far from over on Pillar 1. I think a lot of the follow-on work that's taking place with the regulators, largely off the back of the waiver application process, will go on for a number of years. So I think that's the first element to it. And clearly around Pillar 1 there are some products in there around the securitisations, around things like backstop liquidity lines, etc., that really need revisiting as to how we attribute capital to those. But I think those are fairly obvious. I think Pillar 2 is an interesting area where actually the regulators are going to find that gives them a lot more scope to enter into the areas where to date they may not have put the emphasis that they'd have liked. And I think liquidity risk management, and I'm not saying that was glossed over during the process, but I think most of the regulators would probably acknowledge now that it probably didn't get the attention that some of it, the other areas did, and I think that's likely to be a focus going forward. I think just a revisit, particularly in some firms that have not fared well out of this, as to how robust their processes were. During the use test, it was quite interesting because there's a lot of focus on senior management awareness. But you'd have to question in some of the firms. I mean, there was supposedly the chairman of an investment bank. No idea who it was. It didn't say. He sat before the Treasury Select Committee. Couldn't actually explain to them what a CDO was, despite the fact they traded them quite regularly. And I think that's going to get some focus. I think Pillar 3 is interesting from a couple of angles. One is, of course, because Pillar 3 is still much more in its infancy, what you're going to find is that the regulators are trying to use that to mop up some outstanding issues. As I've said on a number of occasions, I mean, in itself, Pillar 3 is a laudable idea. The danger is if it's extended continuously past a fairly narrow remit, I think it could be counterproductive. There is plenty of instances where investors have gone into, say, very, very structured credits, which had huge amounts of disclosure around them. You're running to 12 to 1,500 pages. And yet, simply because of the quantity involved, they couldn't see the wood for the trees. And I think that's a danger. I think the other thing, as I've mentioned before, is that with Pillar 3, it really is only a snapshot. And in the same way, you'd be wrong to manage your view of a bank, particularly in a fast-moving environment, off its last set of annual reports. Similarly, Pillar 3 doesn't really address that. And isn't particularly geared up, and if that leads to an acceleration of the regularity with which we have to do Pillar 3 disclosure, I think that's going to have to take an awful lot of thinking about. And the comparability between the banks, we're looking at Pillar 3 tables coming out now, and really it's very difficult to compare.
Okay, David, thank you very much.
Thank you.
Thank you.